All right, let's talk about the markets, the Fed, the deal-making environment, and the private equity landscape. Joining us right now to do just that is Scott Sperling. He is the co-CEO of private equity firm THL Partners. And Scott, it's great to have you here on set with us.
Always good to be here.
Man, there's so much to dig through right now.
Sure.
Watching how strong the markets have been, you always wonder what private equity is doing in those times. On the one side, it's great if you want to sell off some of your companies and push them back into the markets. On the other side, maybe it's tough to find deals to figure out what you're going to be doing.
I think that's exactly right. And what we've seen over the course of the last really 36 months is an environment where it's been hard to both buy or sell in private equity. And the level of activity, as we've seen, is lower than it has been in probably at any point in the 45 years I've been doing this.
Really?
We've recently sold a number of companies. They tend to be ones that sell into an AI type trend. You may have seen the announcement of Lattice Semiconductor buying our company AMI. Is an example of that. The ability to acquire companies has been harder because there were a lot of things that were bought in the 21 period in particular, but let's call it late 20 into 22, at valuation multiples that do not reflect today's world, particularly in the software side. That's been obviously covered a lot. Right. And so people are holding on to assets to try to grow into valuation. Private equity makes up a large part of the seller universe, not just the buyer universe for companies, given how much we own, and the fact that we tend to be transient owners. And so that's a source of supply that's been difficult. We've been able to buy divisions of large public companies. There have been some go privates. And I think that will continue to be an area that we're going to see more activity. And I think you'll see the pickup on the private equity side in terms of both selling and, recently we bought companies in the pharma services space, which we think is a beneficiary of AI. That is something that the market is still trying to figure out, but I think they're going to find that AI is a major driver for life science of every sort, both pharma services, for the pharma companies themselves, and as somebody involved with a large healthcare provider, I think it's going to be the savior of our healthcare system in the United States. Because
you're on the board at the hospital in Boston.
Yeah, I chair the board of the Mass General Brigham system.
Okay, so that's where your
yes.
your perspective that you have on this.
And we're making massive investments in AI in every aspect there. Everything to both reduce the administrative burden that takes capacity away from patients in the system, as well as investing very heavily in AI for direct clinical care and for research. We're the largest research institution in the country, and there's major investments we're making in everything from the development of AI to compute. And when you look at the broader markets and the bet that's being made on AI, and again, every aspect, particularly the infrastructure, if you will, of AI. So the semiconductor companies that are so crucial to the build out of the data centers, we just made a 9-figure investment in compute at MGB. It's a lot of NVIDIA servers that you need to do the kinds of model training that are important for life science.
Are you already getting better results as a result of those investments, or is this something you see happening over the next 1, 3, 5 years?
Yes and yes. So on the administrative side, things like ambient note-taking using artificial intelligence has been a big plus and has significantly reduced, again, administrative burden and also physician burnout. We see this whole set of things when we think about it from the THL perspective as sets of opportunities that are going to continue to develop. The markets are clearly betting we're in early innings, and I can't dispute that. I think that's probably true. Whether the valuations on a specific company may run away or not, whether SpaceX is worth 100 times revenues, I don't know. Those are the interesting questions that we're going to see. When you look at some of the major players, though, take NVIDIA, it doesn't trade at ridiculous multiples.
No, it doesn't.
In
fact,
particularly
it's
on a free
less
cash
growth
flow
than some of the other semiconductor companies have.
Exactly.
And lower PEs.
And lower PEs.
Yeah.
But again, we'll see major opportunities there, as we did when we decided to combine AMI with Lattice.
AMI to Lattice, combining that with it, is that because you feel like, okay, we're going to sell this because we think we've done all we can for this company and it's time for it to go out, maybe thinking the prices are right on AI from a seller's perspective
Sure.
right now, or is it that this is the only thing you can sell in this market?
The answer is we've had massive growth in the company since we've owned it, and we've only owned it for a relatively short period of time. But the strategic logic of taking some stock back with a company where you are going to be a major player in the growth in data centers on the compute side, but also in the management of those data centers, is a real opportunity. So
that sounds like you like the
it.
price you're getting. You like the price, and you're not convinced that it's going to continue to grow from here.
No. I would say that the fact that we took stock back.
Because you took stock, you're still riding on the upside.
Yeah,
right?
we took a bunch of cash and we took a bunch of stock, and I think we were happy to take the stock as well.
Okay. When you look around at what's happening with energy prices right now, the Strait of Hormuz, how does that impact your decision making at this point? What do you do?
I think many of us have said that we tend historically to be microeconomic analysts. We're looking at a specific company, we're making a bet on that company and the industry that it's in, and the macro sorts of things are more cyclical, doesn't really affect the secular bets we're making. I would say we're now in an environment where the geopolitical action that we're seeing in so many different ways could have an impact, at least for the next few years, on some of the things that we're looking at. The Strait of Hormuz is a conundrum. We've done a lot to degrade Iran. This is not the first time they've tried it in the Strait of Hormuz, but the nature of asymmetric warfare makes it a more difficult task. We can't really leave them in control of that, so that may have a longer runway, maybe not forever, but maybe longer than the days or weeks that the markets and the American public seem to want to put it in. So you have to think about that a little bit, and really as it might impact longer term inflation rates and that sort of thing, and that impacts valuation multiples.
You said that this is basically the toughest market in 45 years that you've been in private equity. What's keeping things frozen at this moment, and what makes you think that there's going to be a thawing, that there's going to be some movement?
Again, I think much of what had happened was we saw it in the public markets, movement towards better business model that manifested itself most in software. Everyone loved the predictability of those revenue streams and the cash flows that could develop as you got scale. And there was a premium, in our view, put on the valuation of software companies for that period that went beyond the financials or economics, that just reflected the certainty one had about the investment and the cash flows.
And the low CapEx spending that went into it.
And the low CapEx spending that generally went into it. So with the advent of AI, it called into question the certainty of those revenue streams. And it did that in two ways. One, will our customers really need this if they can use generative AI to do some things on their own? Secondly, what does that mean for the pricing that had always been reasonably predictable? So I think what you've seen in the public markets, and then it impacted the private equity market, is the squeeze out of the premium multiple that was put on those assets because of the rock solid certainty that one had about them. And that, again, froze much of the activity in private equity, again, because in that period, that 21, 22 period, a lot of funds put a lot of money to work, and about a third of the investment was made into those kinds of companies. Mm-hmm. And we're seeing that work its way through. Those companies are tending to grow. It's just the multiple that's different. And so there's been a need to take more time. And I think that's what you've seen. We're starting to see that. We're starting to see assets come back at prices that reflect a more realistic multiple today. Mm-hmm. And so I think that's starting to open up.